Imagine this. You lend your friend $100. They promise to pay you back in 10 years. Sounds safe. Now imagine interest rates suddenly double. New loans pay much more. Your old loan pays less. If you try to sell that loan today, you don't get $100. You might get $80. That missing $20, it didn't disappear. It's hiding. Now scale this up. Not $100, not $1,000, trillions of dollars. This is the quiet problem inside America's banks. No alarms, no breaking news, but a ticking clock. This is the $2 trillion time bomb. Banks do something very simple. They take short-term money and lend it long-term. You deposit money today, you can withdraw it tomorrow. But banks lend that money for years. Mortgages, government bonds, business loans. This works as long as interest rates are stable. For years, rates were near zero. Banks bought long-term bonds paying low interest. They looked safe. They were safe at the time. Then inflation hit. Prices rose fast. The Federal Reserve reacted. Rates went up. Fast. Very fast. And here's the rule most people miss. When rates go up, bond prices go down. Always. Banks were now holding bonds worth much less. On paper, these are called unrealized losses, meaning the loss is real, but only if the bank sells. At the peak, these paper losses across US banks were close to $2 trillion. Not cash gone, but value missing. Most of these bonds were labeled held to maturity. That label means we promise not to sell. So the losses don't hit profits. Sounds smart. But here's the problem. Depositors don't care about labels. If people want their money back, the bank needs cash. And to get cash, sometimes you must sell. That's exactly what happened in 2023. A few banks had too many long bonds and not enough cash. Depositors panicked. Withdrawals exploded. Banks were forced to sell bonds at losses, and suddenly, a paper problem became a real one. So here's the truth. America's banks are not broke, but they are sensitive. They are sitting on long-term bets made in a low-rate world, a world that no longer exists. The system survives as long as confidence holds. Because banking is simple. It's not about money. It's about trust. Lose that, and even healthy banks can fail. If you want more simple explanations of how money really works, how debt builds, why crises repeat, and what history keeps warning us about, subscribe, because the next crisis never looks like the last one. So, why isn't the system collapsing? Because of three emergency supports. First, the Federal Reserve stepped in. It created a special lending program. Banks could borrow money using their bonds at full face value, not market value. This stopped forced selling. Second, most deposits are still stable. Despite fear, most people didn't run. Third, time. If banks hold these bonds long enough, they get paid back in full. The loss disappears, but the danger hasn't vanished. If rates stay high, those losses stay large. If deposits suddenly flee, selling returns. And if confidence cracks, fear spreads faster than facts. This is not a bomb with a timer. It's a bomb with conditions.